The market catastrophe of 1929 didn't happen by chance, and one man saw the entire collapse coming 47 days before it struck. How aided it? And why the exact same pattern is locking into place right now is the most urgent lesson you will learn this year. Most people treat a financial crash like a natural disaster. Unpredictable, unavoidable. But that's a story told by the victims. As someone who studies the architecture of wealth, I can tell you the truth. Every major collapse is man-made. It follows a blueprint. And if you can read that blueprint, you transform from prey into the hunter. For the next 10 minutes, we're going to reconstruct the single greatest defensive trade in modern history. We'll dissect the precise, calculated moves made by Joseph Kennedy in the months before Black Tuesday. We'll examine the indicators he watched, from the psychology of crowds to the explosive growth of debt. And then, crucially, we'll overlay that historical template onto our economic landscape today. I will show you that the alignment is not just simile, it's chillingly precise. This isn't about spreading fear. It's about securing a future, because the greatest transfer of wealth in a generation is beginning, and your position is not yet fixed. To grasp Kennedy's genius, you must first feel the frenzy of his era. It's easy to view old photographs and think they were simple times, but the 1920s investor felt exactly as we do now. They were living through a revolution. The radio brought voices across continents. The automobile shrank distances. Electricity turned night into day. This wasn't just a party. It was a paradigm shift. Productivity exploded, and the stock market became the national pastime. For the first time, it wasn't just for tycoons. Your baba, your chauffeur, your teacher, everyone was playing the market. A powerful narrative took hold. The new era, influential economists declared the old rules of boom and bust obsolete. They claimed the Federal Reserve and technology had tamed the business cycle. Just before the fall, a leading voice announced that stock prices had settled onto a permanently high plateau. And people believed him. Why wouldn't they? The rally had lasted nearly a decade. Buying the hot stock of the day, like Radio Corporation of America, could turn hundreds into thousands. It felt like a perpetual motion machine of easy money. Into this euphoria walked Joseph P. Kennedy. He was not a sentimental man. A former bootlegger and banker, he operated in the gray zones of finance. He was part of a group known as pool operators. At the time, it was legal for wealthy syndicates to secretly buy a stock, trade it amongst themselves to fabricate demand, pump the price, and then dump their shares on the chasing public. Kennedy knew the game was rigged because he helped rig it. He understood that prices had detached from reality. But even a manipulator can be ruined if he stays too long. He needed an unambiguous signal to exit. The famous anecdote involves a Shushin boy. The story says Kennedy received a stock tip from the young boy polishing his shoes. In that moment, he realized a critical truth. When the person with the least capital and the worst information is fully invested, there is no one left to buy. The pool of greater fools is empty. That story is a perfect metaphor for peak euphoria. But Kennedy didn't act on a metaphor alone. He acted on a hard number that was screaming a warning, a number with a direct parallel to our moment. The real signal was leverage. In 1929, you could buy stocks on thin margin, putting down just 10% of your own money and borrowing the rest. If you had $100, you controlled $1,000 of stock. This leverage supercharged gains, making everyone feel like a financial wizard. But Kennedy watched the total volume of these broker loans. The numbers were terrifying. They had ballooned from a few billion to over $8 billion in just a few years. The entire market was being propped up by an ocean of debt. Kennedy saw the mechanics of disaster. A minor dip would trigger margin calls. Forced selling would drive prices down further, triggering more margin calls. It was a mathematical chain reaction waiting for a spark. So, what did he do? He sold early. In the summer of 1929, as the party roared on, he liquidated his holdings. He moved into cash and government bonds. This move is psychologically excruciating. Imagine selling your winning positions today, only to watch them climb another 20% next month. You face ridicule. You botto intense FOMO. But Kennedy had the discipline to leave the final 10% of gains for the crowd, securing the first 90% of his capital. The smart exit always looks premature. But he didn't stop there. Going to cash was just a fence. Kennedy then went on the offensive. He began to build massive short positions, betting the market would fall. When Black Thursday and then Black Tuesday arrived, and the margin call cascade ignited, his wealth didn't evaporate, it multiplied exponentially. While the nation's savings burned, he harvested fortunes. And when the dust settled, with assets at fire sale prices, his cash held immense power. He bought prime real estate and businesses for pennies. He didn't just survive the collapse. He used it to build an empire. Now, why does this matter to you? Right now, because the script is being rehearsed again. The actors wear different clothes. The technology has new names. But the plot points are identical. In the 1920s, the new era tech was radio. Today, it's artificial intelligence. The narrative is identical. This changes everything. And it does, but that doesn't justify any stock price at any level. The Shoeshine Boy indicator. Look around. Financial speculation is now a mainstream hobby. Your delivery driver debates Fed policy. Viral posts convince novices to trade complex options. The saturation is total. But the most dangerous parallel is the leverage, though today it's more sophisticated. It lives in a derivatives market, valued in the It's in the explosion of zero-day options trading, where people gamble on hourly price moves, and it is most visible in the ultimate margin debt. The national debt itself. We are borrowing trillions just to service past borrowing. It's a pyramid scheme on a federal scale. The warning signals are flashing. The yield curve has been inverted for a record period, a reliable recession predictor. And crucially, insiders are selling. The founders and CEOs of the world's largest tech companies have been offloading billions in their own stock this past year. They aren't buying the top, they are distributing it to the public. So, what is the modern playbook? How do you adapt Kennedy's strategy? We break it into 3 phases: the exit, the hedge, and the acquisition. First, raise cash. Take profits on speculative positions. Build liquidity. In a crisis, cash is oxygen. Second, hedge with real assets. Kennedy held dollars, but our dollars can be printed infinitely. Allocate a portion to timeless stores of value like gold assets, with no counterparty risk, that protect purchasing power when currencies are debased. Third, prepare for the acquisition. When fear is peak and assets are distressed, your liquid reserves will have kingly power. You'll be able to buy quality at a fraction of its value. The final, most difficult component isn't financial, it's psychological. You must fight your herd instinct. Selling early feels lonely. You will doubt yourself. But remember, the crowd is always wrong at the extremes. They were wrong at the peak in 1929, in 2000, and in 2008. The signal is flashing. The countdown is underway. You have a simple choice. Remain in the crowded dining car, celebrating as the train speeds toward the gorge, or step onto the platform with your capital preserved and your eyes open. I've made my choice. I'm following the blueprint. For Winds of Thought, I'm Istora Labs. If this breakdown provided clarity, please like the video to support the channel. Now is the time for decisive thought. We'll see you on the other side.